For the little 2023 forecast. This has been quite the ride, quite the fun year, and here we are to wrap up a 2022 and looking ahead to 2023. So pretty excited, and wait a moment for people to engage and get on. But okay, I see that there are people, so we'll go ahead and get this party started. All right. Shrink my little head down so we can go ahead and get this forecast going. So first, of course, we're going to start off with some funny things, some funny slides that I totally enjoy, just so that we can get into the flow before we dive right into all the economic data stats. So I'm sorry I'm late. The traffic was crazy. The traffic. Cheers to that. This is self-explanatory. I love this. If you're going to have a Tesla van, it needs to run on electricity, not gas. Feliz Navidad. You're welcome. Buyers, I hope interest rates don't get any higher. Interest rates, right? When your clients give up on the market and buys a house from IKEA, that would be a lot of fun. Might take a minute or two. Experienced agent in a market shift. No offers, but I have a couple verbals, and I'm showing it again to someone this afternoon who's already seen it 17 times. Yeah, this is funny because this probably gets the most laughs recently, because this is exactly what everybody's experiencing in the marketplace right now. So apparently this is a listing photo, and apparently Pepto-Bismol is a color. And this was a listing photo also. It was the only listing photo where the real estate agent didn't even bother to get out of the car and snapped a photo right through the window. And I'm convinced, the more I see this, the more I'm absolutely convinced that some dude lives in this house all by himself, is now trying to sell the house, and is going to have a hard time. Seller's not listening to the market. I think that's great. Seller who listed in January 2022 and seller who waited until November 2022. But you know, at the end of the day, he's still wearing the belt. That's what somebody pointed out. When your seller finally agrees to drop the price, $24.95 to $24.94. Please don't do that. So I'm going to give my introduction. And for those of you guys that don't know who I am, a quantitative economics decision sciences major from UC San Diego in the beautiful city of La Jolla, 31 years in the business, Orange County native, Capital Valley High School grad. Yes, I do have 9 kids. My wife and I brought the 6 on the right. My wife brought the 2 on the upper left. I adopted her. She adopted mine. We had Zeke. Big happy family. Can't wait for our Christmas Eve to arrive at our doorstep, because we're hosting, and it should be a lot of fun. So we've been all over the press, from the Financial Times, London, and everywhere in between, and that's our company. It's Reports on Housing. It's your local real estate snapshot. It's about driving home the strength and power of data to everybody out there, so they could properly make expectations based upon what we're seeing. And it's meant to cut through all the noise, because quite frankly, everybody has an opinion when it comes to real estate. Everybody does. But when you lean heavily on all data, not just housing data, but all economic data, it really does paint a more complete picture. But it is dizzying out there, all of the different YouTube, Instagram, TikTok, Facebook posts, everybody has, and Twitter, everybody blows up all over the place. It is so much different now than it was even in other time frames where we had a different kind of economic situation. So this is going to be completely different, and it's best to cut right through all that noise and just hit the people out there that are delivering facts and data, good, sound, boring economics that you can rely on, the complete picture, not just little snippets. So we don't focus that much on closed sales data. We will go over what we think closed sales data is going to be, but in today's presentation, that is not what we're going to, and that's because we don't really focus that much on it. Instead, we're going to be bringing a lot what's going on right now today. How many supply and demand is what we talk about, with the available number of homes being supply and demand being a snapshot of recent pending sales activity. So, new escrows. I always say that escrow people that work in escrow companies know really what's going on with demand, the ebbs and flows of the marketplace, probably before everybody else. And from supply and demand, based upon pending sales as well as available number of homes, we're able to get you the speed of the market based upon that mix. How fast is the market moving? And we call that expected market time. We throw away days on market. It's not an accurate statistic. It's not a real good gauge on how fast the market's really going, but expected market time really does bring it home. And the reports that we put together are used for buyer and seller consultations, getting price reductions, get buyers off the fence, and just to have more escrow transactions, close more escrow transactions, by properly setting everybody's expectations so they can make the best decisions for their families. And we have reports that dot all over Southern California, and we are nearly at the finish line for the Bay Area. We're going to launch it after the first of the year, but it is finishing up the charts and the data and stuff, getting it all looking pretty. So we can launch it at the beginning of the year. And so far this year, these are what some of the reports have been like. And the reason why I'm bringing it up, because it kind of paints where we've been and where we have gone from the beginning of the year. Beginning of the year, it was 2013 for all of Southern California combined was a very, very hot market from day one. Then 2021 last year was the hottest market that we'd ever experienced. It beat 2013. This year was even hotter, and that's because inventory levels dropped down to ridiculously low, anemic levels that we had never seen before. So that was what started off this year. Then we moved on to, will it slow in 2022? And I'll answer that, but basically we mapped out where with higher interest rates, what was going to happen to the marketplace if they stayed around with duration at the higher levels. Housing cracks formed because we had those higher rates. Sky's not falling. There are a myriad of different reasons. The strength of homeowner, we'll get into that, also has a lot to do with why this is not going to be a repeat, and we're not going to have a housing crash. And affordability challenges. Of course, when you have rates that drive up as high as they are, you're going to have affordability challenges, which we continue to have today. But there has been a little bit of easing. We'll go over that. Home values. The reason why values won't plunge, you can take a look at it. If you look really, I have a chart that was given, and it compares everything prior to the Great Recession, what's setting up the Great Recession, to where we are today in the housing mix. Way different, polar opposites. There are a myriad of different reasons why this particular downturn that we're experiencing right now today is not going to be anything like what we saw in the Great Recession. We do have a very low supply, and we have a low demand. One favors sellers, one favors buyers. And hunkering down, that's a new statistic that we didn't think was really going to be real, where people wouldn't move, like homeowners would opt not to move. And I'll go over what I mean by that momentarily. Sky high rates, we'll go over what sky high rates have done to what the monthly payment is for the median priced home in all of Southern California. We've broken this down by county too. Pricing is crucial. It talks about the very, very important piece of pricing. And I do have a chart that will help illustrate this quite a bit. And it comes from this article that we wrote on it called Reduce and Net Less. When you have to reduce the property by more than 1%, you actually net less. And if you have to reduce by 5% or more, you even net far less than those people that just reduced it by about 1 to 4%. So a holiday pause, that's where we are today. And the most recent one that came out is no crash in sight. So we did talk about crash again, wanted everybody to understand exactly where we were coming from, talked about the unsold inventory and inventory levels throughout all of Southern California's counties. And it's also like that across the United States. I'm a total nerd, love what I do. This has been a lot of fun. I'm looking forward to having a little bit of relaxation time with the family over the holidays, but don't get me wrong, I will be paying attention every moment to what's going on in the economy, just because I thoroughly enjoy it. And we do have an economic model that we follow at Reports on Housing, and know that it's called a progression model. And that's because there's new input constantly coming in with new charts, new data, new stats, like the Fed speaking yesterday, like consumer price index coming out a couple days ago. So when we continuously get these new pieces, we put that into all of our models so that we can figure out exactly where we're going from here. And you go to reportsonhousing.com. That's where you go to subscribe. And it's $15 per month or $150 per year, and you get a month free. Actually, you're going to get 2 months free. I was doing this for a limited time, and the coupon code when you go in there is 2023 if you want to subscribe to the Housing Report and you don't already. So let's talk about inflation and interest rates. The Federal Reserve, at the beginning, 1 year ago, right now in December, so they were teeing up what they were going to do. They had already talked about that they were going to stop purchasing bonds and treasuries, and they were going to mortgage-backed securities. They're going to stop doing that, and there would be some quantitative tightening, and there's a number of different things that they said that they were going to do. However, when they talked, and when you look at the Fed minutes and you look at what they were saying, they were kind of tiptoeing around everything. It almost felt like, what are they really going to do? And they're just trying to really test the water to see how the markets would respond. That was a year ago. And the way that they were talking is way different as the year progressed. As the year progressed, they continuously turned up the heat until we got to August of this year. When we got to August of this year, all of a sudden interest rates dropped back down from 6% down to 5%. And then we saw Wall Street going up as well. They did not like that at all. So they met at Jackson Hole, Wyoming at the end of August, and they came out. Jerome Powell, the head of the Federal Reserve, had an 8-minute speech, and he came out swinging. He had no Q&A afterwards, and they came out swinging. He talked about a lot of pain, that the pain that it's going to cause the consumer, the pain that it's going to cause companies, and that they're going to stay the course and they're not going to pivot. They're not going to come back down and help out with lower rates anytime soon, and all through 2024 or 2023. So that's what they've been talking about for ever since coming out of Jackson Hole, Wyoming. It's not just Jerome Powell, it's all the different presidents of the different areas where they have the Federal Reserve, and they all are coming out swinging, constantly talking about the pain that they're going to cause and how they're not going to relent. And they want that message to be felt and heard so that the markets will move the direction that they want the markets to move. And by the way, interest rates have already priced in all this stuff. So they met this week. In Washington, D.C. This is what it looks like, the windowless room that they're in. I wouldn't mind being in there because it'd be a lot of fun to listen to what they have to say. But they came out, and of course they did that Fed rate hike, and it was exactly as everybody had transcribed the way that it was going to go. We've had those 4 3/4 point increases, and then yesterday we had a half point increase, and that brings the federal funds target rate. And no, this is short-term rates. This is when they talk about this. This is the way that banks exchange money. It's gone up a half percent yesterday. Now understand that this is credit card debt and equity line of credits and automobile loans are what are tied to the federal funds target rate. Now you can see this, where they're at today is now at 4.5%. So they went from 4 to 4.5%. It's actually, they have an area, it's between 4.25% and 4.5%, but we'll call it 4.5%. You draw a line across and you can see that we're making our way back to where we were right at the start of the Great Recession. Now, but the difference is you could see how we slowly but surely, prior to the Great Recession in the middle over there, you could see how over here there was a very stepped up, methodical increase over time. This time around, the increase was almost immediate, and it was just straight up and down practically when you look at this chart compared to other times. Now, if you look over here, this was what Paul Volcker did back in the 80s, the early 80s. He actually took the federal funds rate from 10 to 20 and then brought it back down to 10 and had to go to 20 again. That's exactly what Jerome Powell, today's Federal Reserve chair, wants to avoid, and they just want to have to do this once. They don't want to be going up and down with the federal funds rate. Now, Paul Volcker did it back in the 1980s, and that was to fix inflation because inflation was out of control for years. There was arguably some Fed chairs prior to him that really weren't doing what they should have been doing, and he brought everything into where inflation was now more moderated and in control at the rate of about 2% per year. And we're having an issue again, and that's why Jerome Powell is trying to get this issue of inflation under control. Now, realize that when you go from a 0.25% up to 4.5%, that's an 18-fold increase versus a doubling back when Paul Volcker did it in the 80s. Now, the Fed is moving historically fast to tame this inflation. You could see this. You could see that blue line is 1983, and it's everything done since 1983. You could see all recent historical moves in the federal funds rate. This is the fastest that they've gone, which is why we're experiencing something completely different today. And I do want to point this out. I know that this is hard. This is called the dot plot. And this is what they come up with this every quarter. So I'm going to show you, this is where they were in September. What they're saying is where they would like interest rates to be. Now, this is where they thought interest rates would be in September by the end of the year. And you could see it's kind of hard to see in this, but maybe if I shrink down my face a little bit. Anyways, that didn't work, but you can actually see up here in the middle, this is right at 5%, and this is at 4.5% right here. Where they ended up being on the right-hand side is right at that 4.5% level. So kind of where the majority of them were is where they ended up. Unanimously, they're at 4.5%, and this is this week. So this is where they're at right now for the short-term rate. Now, as far as next year is concerned, here's the difference between where they were in September and where they are right now as to where they think they're going to go for next year. Now, if you look at that, the average of it was probably everybody was thinking that it would be around 5%. Markets were thinking that it would be between 4.75% and 5%. Instead, they've done about a 5 to 5.25%. And that's where they're sitting. So they're sitting a little bit higher, but a lot of the overall market investors out there do not believe that the Fed's going to have to go as far as they're saying that they're going to go, even though they put this together. This was actually one of the negative points of yesterday's release, but and then they also talk about where they're going to be in 2024 and 2025. And then the longer run, but know that they barely know where they're going to be next year. So those arrows are pointing to areas that they have no real idea of where it's going to be. But if you draw a line, you can see down the road that they will actually, in the short-term rates and long-term rates will start to go down if it follows this projected path that they're talking about. Now, inflation has, of course, been out of control all year long. And this is where inflation is. Now, the headline inflation is the red number, and the latest headline is at 7.11%. But this is important because you can kind of see that inflation was really ticking high. I'm going to argue that 7% is still really way too high. However, I'm going to argue when we were at 9% earlier this year that showed you where that we had finally hit a peak, and now we're coming down. As a matter of fact, we came down so much. This was lower than expected. And if you look to the left of it, where it was last time at this level, just about an inch over, that was December of last year. So pretty much this is the lowest level since December of last year. And then core is taking out the volatility of food and fuel. Now, when you take out the volatility of food and fuel, you can see this is actually coming back down, and it's coming down at a pretty good clip. It was better than what was expected as well. And it was only up 0.1 per month. And that is actually a good trajectory if that was to continue. The expectation was for it to be 0.3. So this was way better than what people had thought. If I draw a line across, you can see the last time we were here was like 1982. However, it continuing to go down, and it's getting very, very close to where we were in 1991, and it will continue to go down as next year progresses. Will it go straight down? No. There's going to be some choppiness to this, which is what I'm always concerned about. But now we have 2 months in a row where inflation numbers looked good. So that's actually really solid news. The CPI, as far as when it's just a mixture, it's a whole bundle of different goods. And you can see this is the bundle. It talks about that. There's still all of it together is food, energy, electricity, apparel, medical care, shelter. It's the whole basket of everything. And this is the piece that is included, and it is shelter. And shelter, there's a big lag. So even though leases are coming, the rents are starting to come down a little bit, the whole overall real estate market is going a lot slower. This takes time for this to start to go down. I imagine that once we get the reading for January, which we won't get until February, that reading is going to be the first time that we start to see this thing come down. And but know that this has been adding extra juice into the CPI, and this is going to start to come down. And this actually right here, this is services. Now, services, you can see at the right hand, at right where I'm pointing to, it was going up at a very steep rate. It only went up slightly this from month to month, but it's still going up. And the reason this is such a volatile piece, and this is what the Fed's looking at probably the most, and that is because wages are continuing to go up, and they're making this piece of the CPI continue to go up. So this is all services. Now, services, you have to understand that there is a real problem on the job front, and that is there's not enough workers for the number of jobs out there, and it's putting too much pressure on wages, and that is why we're seeing this thing skyrocket like it is. And if you want to see what's happening to a whole bunch of goods, this is very interesting chart, and this is just year over year. Some of the things that are in the CPI and some that aren't, but I find it interesting that eggs are up 49% year over year. And airfare actually is coming down a little bit right now. But you see it when you get to the middle of it, it's where you get to new vehicles, 7.2%. But at the very bottom are items that are coming down. And you can see one of the big pieces is used cars and trucks is finally going down year over year, as well as car rentals. That's important. Smartphones, who would have known that? But what I was just mentioning were all part of CPI. So I'm excited about the trend that we're seeing. This is actually really good news. You know, when you're in economics, you know that it can vacillate from month to month. But when you got a couple dots that go together that look like it's a trend that's forming, that's where we start to get, you know, we reserve our excitement, but we're a little bit excited because the trend is our friend. Does it mean there's going to be some volatility going forward? Absolutely, there can be. So this is what's going on right now with the U.S. 10-year Treasury. And know that the 10-year Treasury is closely linked to 30-year mortgages. It's not one for one, but typically when the 10-year treasuries go down, interest rates go down. When 10-year treasuries go up, interest rates go up. And there's a real stickiness to it. So that's why we look at 10-year treasuries, because there's typically, when you look at treasuries, you can add a certain number and it gets you exactly where you need to be. So someone who just asked, why is the 10-year bond rate falling? And it's falling because we're at the point right now where everybody is pricing in that we're going to most likely go into recession next year, that the Fed is done with what they're doing. As a matter of fact, this is going down. So our interest rates are going down right now. The Fed spoke yesterday. Guess what happened to interest rates? They raised the short-term rate 0.5%, but interest rates fell. And guess what they did today? They fell even further. So even though there was that 0.5% increase, interest rates, they're interesting. The move was the exact opposite of what they were talking about. And that's because we're talking about long-term interest rates. So, but I'll get into all those questions maybe towards the end, and I'll answer some of those afterwards. We'll see what kind of time we have. But this is the 10-year Treasury. Right now, it fell below 3.5%. This is as of today. I think it's even less than that right now. I think it's at 3.45, if I'm not mistaken. But this is where we are right now. This is where we went from the start of the year to where we are today. So this is why we have higher interest rates and higher 10-year treasuries. We started off the year with 1.51%, and now we're at 3.48%. It was higher. It was well above 4%. And when this was well above 4%, we had interest rates above 7%. They hit a high of about 7.39, according to Mortgage News Daily. And if you look at Mortgage News Daily, today we're at 6.13%. So it fell from it was about 6.25 yesterday down to 6.13%. So it's continuing to fall, which is good news. The last time we were here was November of 2008. When we were up in the sevens, I was saying the last time we were here was in 2002. So we're going the right direction as far as rates are concerned. And so November 2008 was the last time we were here. And you can see where interest rates have gone from the start of this year to where they are today. And we started off at 3.25%. Today we're at 6.13%, still a lot higher than where we were at the beginning of the year, which is why the market continues to be sluggish. And but this stickiness between the 10-year and the 30-year mortgage that I was talking about, this is the 10-year Treasury and the 30-year mortgage. 30-year mortgages are the is the red line, and the 10-year is the blue line. Now, normally there is the going back 35 years, it's 1.71% higher than 10-year treasuries is where 30-year mortgages are. So 1.7 is about where that little yellow bracket is. And we've been there for quite some time until we got to 2022. And we were there for quite some time prior to the pandemic as well. So right now you can see the spread is way larger. It is extremely large. You have to dial back for decades to find the last time. And there was one other time that we saw this recently, and that was when we went into COVID. And actually the spread right now is larger than it was during COVID. When we first went into COVID, all of a sudden, all investors in the financial system actually seized. It stopped, and things weren't working and behaving the way they should. And a lot of it had to do with servicers. When we go this parabolic with rates, there's servicing companies that actually take care of collecting the monthly mortgage amount and taking care of making sure that escrow and that the insurance and property taxes are paid for and all that stuff. That's called servicing. And they're going to charge more for servicing because what they pay to service these loans. Now, what happens in this kind of a market where you have interest rates that go way up, they're anticipating that when interest rates come down that they'll lose money. So that's why they're pricing that in, and there's a lot more risk. So there is a bigger discrepancy, and which I find extremely fascinating, because where we are today is at 6.13%. But if you put the true spread of only 1.7%, which goes back 35 years, interest rates today should be 1% lower at 5.14%. And the reason I'm pointing this out is because once interest rates start coming down next year into the fives, we're going to see that this spread starts to diminish. So we can have the 10-year Treasury not even move, and yet interest rates come down a little bit more just because the spread is so high. So that will change as we come back down to earth on mortgage rates. And I know people say we've had mortgage rates that are higher. It has nothing to do with today's marketplace, because today's marketplace has a lot higher home values. So interest rates in the fives will start to repair that discrepancy in the 10-year Treasury, between the 10-year Treasury and the 30-year mortgages. So labor markets is something that the Federal Reserve is very, very concerned about. I too am concerned about. And the reason for that is because there's about 2 jobs for every job seeker. The number of job openings is just absolutely way too high. And you can see this right here. That blue is where we have 10 million job openings. If you look back in time, we've not really had that kind of job openings. And people are saying there's a lot of workers that didn't come back. That's only part of the problem. We also had a lot of people die from COVID. So there's a number of different reasons. We had a lot of baby boomers end up retiring and leaving altogether. So, and then unemployment rate is far too low as well. They want their unemployment rate to be up in the fours, and that's why they continue to hammer away at the economy until they start to see that unemployment goes up, so that it's no longer 2 jobs for every job seeker. It's at least get closer to 1 job for every job seeker. It won't put as much pressure on wages. And the reason why they don't want to put that much pressure on wages is because if there's a service company that has to hire and pay more, they're going to in turn charge more for the goods that they provide. That's the issue. We see that at restaurants. Things get more expensive. If they have to pay them more. So what ends up happening is they call this a wage price spiral. So when they continuously are asking for more money, the retailers or everybody out there has to charge more for the goods that they provide. So what they want to do is put a lid on this so that we don't see wages going up at astronomical level, and then we have prices going up, which just feeds into more inflation. So there is a recession ahead. All of our recession flags have been blowing since August, and that means that most likely a recession is going to happen. I don't know when. Nobody really knows exactly when. I'm surmised that most likely we're going to see a recession in the second quarter of 2023. And know that every time we have a recession, guess what happens to mortgage rates? Every single time. I've downloaded the mortgage rates since the 1960s, but every time we have it, or since 1971, that was when they started doing it. So every time we've had a recession, what we've had is interest rates come down. And ever since 1980, 1981, 91, you can see this is how much there was a change in interest rates. Now, there are larger changes in 1980, 1981 because the interest rates were a lot higher back then. Interest rates are a lot lower. So if we get an interest rate movement of 1%, you can imagine if we're at just over 6, now we're down to the very, very low 5s if you subtract like even 1 point. So, but every time that we've gone into recession, we've had rates fall. Now, what happens when rates fall? We see an increase in demand. We've already seen it in this year, and we'll get into that in a minute. Where do I think interest rates are going to be? My lid used to be a lot higher. My lid is now 6.5%. That's only if we have some CPI or some weird off reason that we should go higher. But I strongly feel that we're going to watch interest rates go down into the 5s. We could get to the low 5s by the end of next year. We could even possibly, there is argument and things that we can see interest rates getting down even with a 4 handle, like a 4.75%. So that's why we have that range. So let's talk about the housing market. But first, I'd like to thank our sponsor for bringing us this program, this 2023 forecast, Alan Mack from Mack Financial Services. He has been a sponsor of our housing debrief as well. So I wanted to thank him for sponsoring this 2023 housing forecast. And he has the program. He's a $1 million plus program, and it's really superior luxury residential financing is what he focuses on. And know that he can go anything above high balance. So it doesn't have to be million plus, but he deals with a lot of million plus product. And he deals with non-conforming loans above 647,200. That'll change, I think, because the jumbo products are changing for 2023. But he shops for the lowest rate. He gets the best rate in town. And he has a network of private and regional banks that he works for. He knows the best of the best in these banks. He leverages that relationship with them. He has also deals with high net worth clients where they have to do something a little bit different, cash flow analysis, asset depletion. But he can deal with your non-conforming loans above the conforming limit, and that is just about everybody that's out there. He has a special 2-1 buy down. It starts at 3.125%. So I think this is a fantastic product as well. Experience matters. He has loads of experience. He's been doing this for a super long time. Since 1988. He has over 100 5-star reviews, unparalleled knowledge. So Alan Mack, he's part of the 5-star professional as seen on Forbes. He just made the most recent issue, and you can contact Alan Mack and let him get you the lowest rate for you or your clients. Alan Mack from Mack Financial Services, 949-929-1091. So thanks, Alan. Really appreciate it. And let's get back into the housing market. Now, where we're at, we have a seasonality. We've had a seasonality this year as well. Yes, things were slower, but there was still a seasonality to the marketplace where spring is the best, then summer, then autumn, winter is the next. But there is a slower season, that's the holidays. And guess where we are? We're smack dab in the middle of the holiday season. That's where we are. And that's where supply plunges as well as demand plunges. Both of them plunge at very, very similar rates. Most recently, within this last week, actually, supply plunged faster than demand. What we've been dealing with this year is a very, very low supply and a very, very low demand. So they've been going at it this year because the low demand favors buyers, low supply favors sellers. And let's get into the housing inventory. This is across the United States. This is compliments of Altos Research. And you can see we're at 535,000 homes across the United States. It actually came down faster than what it normally does at this time of year, but it was hanging up higher for a little bit longer as well. And in 2019, at this same time period, we were at 834,000 homes. And that was drilling down after years and years of it going down slowly but surely, getting down to 834,000 in December of 2019, teed up an incredibly hot start to 2020 prior to COVID. We were going to have an exceptionally hot year. But my point in showing you this is even at 834,000, we are far below that. So we're still far below where we were prior to the pandemic across the United States and also in SoCal. Now you can see, as far as inventories are concerned, I like to point this out. Where we're at right now, that last slide was just detached homes. Where we are right now, and this is according to National Association of Realtors, about 1 million homes on the market, right? Now, prior to COVID, we had about 1.5 million. And that's where we would kind of like to be, is 1.5 to 1.75 million. That's where we really need to be. And if you look over here, what the arrows the arrow that is highlighting that really high Himalaya, that is during the Great Recession when we had close to 4 million homes on the market. We have 1 million right now. That was a supply glut. And even prior to the Great Recession, it was about 2 million homes. So we had fewer homes during the expansion years from 2012 through 2019, and then COVID happened. And now we have far fewer homes in the market. And we have what I refer to as a supply crisis versus a glut of homes. The good news is this year we got some of our supply back, but we still are dealing with a supply crisis. And I'm going to show you Orange County. The reason I show you Orange County is because I'm going to draw a line right through the middle. I want to point this out because I've been following Orange County since 2004. Then the rest of SoCal, I brought them online in 2012. So the chart that I'm about to show you in 2012 is missing these Himalayas on the left. Right now, Orange County has very few homes in the market. It's about 3,600. We'll get into exactly how many homes they have in a moment. But you could see prior to the Great Recession and during the Great Recession, there were a lot of homes, 16,000 in 2006, 18,000 in 2007. That is called a glut of homes compared to where it is today. And so now I'm showing you all of SoCal, and you can see that black line to the left. It's missing the Himalayas of the Great Recession. So now we're looking at where we have been through the expansion from 2012 on. And where we are today, yes, we have been lower during COVID, but still we're at a very low level, and it's only going to drive lower to start off the year 2023 in a few weeks. Now, I'm showing where Jackson Hole, Wyoming is because that's where they met and they came out swinging and talking about pain. And I want you to see that the inventory had peaked and then went flat after that. And that's because interest rates were rising. So with interest rates rising, demand fell and some of the homes languished on the market for a little bit longer. So the inventory went flat. It would have continued to go down. That's typically what happens when you reach a peak. Now, December 8th, last week, we were at 27,479 homes. It went down 5% or down 1,454 homes in a 2-week period for all of SoCal. That was the largest drop of the year. The 2 weeks prior was the second largest drop. It was like 1,420. So it was very, very close. But the prior 2 weeks was even a larger drop. Last year, we were at 14,580. So you get it. Last year, there was nothing on the market. And the 3-year average prior to COVID is about 36,000 homes. We're far off the 3-year average prior to COVID. We're missing quite a few homes. Now, today we're at 26,455. So it's been another week, and I snapped it, and we went down another 1,000 homes in just the last week alone. So the market continues to plunge as far as inventory is concerned. Now, SoCal supply, Los Angeles is at 9,349. Now, that down 11% is down compared to where the 3-year average prior to COVID, 2017, 18, and 19. So it's missing quite a few homes, off 11%. Now, Orange County is at 2,939. I was off on what I was saying. 2,939. It's off 36% compared to the 3-year average prior to COVID. So it's missing quite a few homes for this time of year. Riverside is 6,115, missing 27% compared to this time of the year, the 3-year 2017 through 19. San Bernardino, 4,581, missing 21%. And San Diego, 3,471, down 38% compared to that 3-year average. And Ventura is at 851, off 35% compared to 3-year average prior to COVID. You get the picture. There's not enough homes on the market, with the exception of LA. LA is a little bit different. They're so macro. You'll see the difference in demand. So they're a little bit different. As far as the Southern California active inventory for the rest of the year, we're just going to watch this thing continue to drop from here. And the number of reductions across the United States for detached homes, this is also from Altos Research, 42.1% of all homes reduced their price at least once. This is a lot higher than where we normally are. And you could see where we normally are is close to 30%. And so SoCal is at 43%. So 43% of everything has reduced the price at least once. And that's just goes hand in hand with what's going on in the marketplace, where it's a little bit harder to sell. So this is what I wanted to point out. This is the month of October, all closed sales in all of Southern California. So for the closed sales, believe it or not, 61%, and this is like this in all counties. If you price it right and you're in good condition, you will fly off the market. 61% of all closed sales in October had no reduction and sold for 99.1% of their list price. So the sales to list price ratio was really close. They got close enough to their list price. The median days on market was 9 days. The median sales price, I'm just telling you where the median is for that tranche. But what I'm trying to point out here is that they're all very, very similar. So some people argue that the people that that have to reduce more, the luxury end, and I want to argue that that's just not the case. 1 to 4% price reductions, which is 15%, actually get a sales to last price ratio of 97.4%. So they reduced it and reduced it and reduced it. And then once they got to where they needed to be, they actually only got 97.4%. Now, and they were on the market 43 days. 5% or more price reductions, 1 or 2 or 3 or however many got them, 24% of the market, they got 96.7%, so even less. And they were on the market for close to 2 months. Now, for $1 million home, if you didn't have to reduce it at all, you got $991,000 based upon this math. For $1 million home and you reduced it between 1 and 4%, now you're netting $974,000. So you just threw away some of your equity by not pricing it right out of the box. 5% plus, $967,000 is what you netted. You even threw away more money because you were grossly overpriced to start off with, got to the right price, but had to give up more. The rationale behind this is you get the most bang for your buck and glitz when you first come on the market. You do not get as much activity once you start making those price reductions. So you want to take advantage of initially coming on the market, pricing it right, having it in the best condition and location, all that good stuff, or best condition and everything that you can control. You can't really control location, so have the thing priced right if it has an inferior location. Southern California, number of homes coming in the market, we are in the month of December. See, there's only 11,390 on average for December prior to COVID, 2017, 18, and 19. That is the 12th slowest month for the number of homes placed on the market. May is home to the most. where there's 27,212. But look what happens in January. We're going to go from 11,000 to doubling in January. So there's a lot more homes that come on in January. February would be close to the same as January. It's just there's fewer days on the for the month of February. And then March is where we start to see it climb, April, May. And this is like this with all counties. And but there is this thing called hunkering down that's occurring right now. And that is people might not be in love with their home and they want to move, but they're staying put. This lovely couple wants to move because they're going to have a baby, but you know what? They're not going to move. There's a lot of people that would be inclined to move, but aren't. And the reason for that is because they are hunkering down. And they purchased, let's say, anytime where I circled this, and even through 2021, you could see that I'm taking California Association of Realtors median detached price and plugging in the interest rate, the average interest rate for that month. And I did that over time. And you could see, and I chart and I plotted this. So interest rates is that orange line. You can see interest rates were going down. And what happened were while interest rates were going down, the payments for a median detached home, even though it was going up, was pretty much flat. It didn't change that much. And this is for all of SoCal. But then we got into 2021 and it started to rise. And you could see in January, it got to $2,970 per month in January of 2021, when it was a bit lower than that. And it continued to ratchet up until we got to January of 2022. Now we're at $3,520 per month. Well, most recently, we were really high. And that was in the month of September, we were, or that was the, month of October, actually. We were at 4,587 with an interest rate of 6.9%. So today's interest rate of 6.13% brings us at 4,234. Now, I want everybody to know that we had a height of interest rates at 7.3%. When they were at 7.3% to where they are today at 6.13%, it is a savings of $541 per month, or about $6,500 per year less, now that interest rates have come down from 7.3 all the way down to 6.13. And you can see the difference just from 6.9, from 45.87 to where it is today at 42.34, which is also an additional saving. So as this is going to be interesting going forward as we see next year, because we anticipate interest rates to come down a little bit, and watching that is going to show you where affordability starts to come back into alignment. And values have been going down, which has made this ease as well. So the combination of values slowly going down as well as interest rates going down, the combination of those two will bring us to a sweet spot someplace next year, most likely. And hunkering down is for real because people are deciding not to move. I showed you that they've locked in at very low rates, and and payments didn't change over time. 89% of all Californians with a loan, and it's like 60% have a loan, 40% own their home free and clear. So those 60% with a loan, 89% have an interest rate at 5% or lower. 71% have an interest rate at 4% or lower. 29% have an interest rate at 3% or lower. Now, the number of new listings coming on the market, you could see over here, there aren't a lot of homes on the market that are coming on the market on a monthly basis. This orange line shows you the number of homes that came on the market for the month of November, is where I'm pointing to, versus prior years. And we plotted that, and you could see the different years. The green line is COVID, and you could see there were fewer homes came on the market when we were locked down in COVID. And then we got to the red line, that was last year. It's a bit closer, still off from where it was prior years. And let me show you exactly what happened. In 2020, compared to the 3 years prior to COVID, 2017, 18, and 19, it was down 9% compared to those 3 years. And on average, almost the same number of homes come on the market every year, give or take 1 to 2%. And it's off 24,000 homes, 24,000 missing for sale signs for the year 2020 for all of SoCal. In 2021, a little bit less, 19,600, 7% less. But in January to November of this year, it's off 18%, missing 48,000 for sale signs. And in November, it was off 31% alone for that month, missing 5,500 for sale signs in just that month. Hunkering down, actually, as I've been tracking this, has deepened. And it was the most last month. So for LA, it's off 16%, missing 14,000 signs so far this year. Orange County is off 21%, missing 8,000 signs. Riverside's off 14%, missing 6,500. San Bernardino down 19%, missing 6,800 compared to the 3-year average prior to COVID. San Diego's off 25%, missing 12,600 for sell signs. Now, we've talked about the inventory side. Let's talk about the demand side of things. You can see the orange line is this year. Demand has totally been muted. This is a snapshot of 30 days of pending sales activity. And Jackson Hole, I'm pointing to, you can actually see what happened in the month of August when we had interest rates that went into 5%. Demand actually started to rise. And it rose until Jackson Hole, and then it really went down as interest rates started to go from 5% all the way surpassing 7%. On last week, we were at 8202. That was down 6% in a 2-week period of time, off 490 pending sales. Last year, we were at 15,328. That's 87% higher in the number of pending sales. So that's quite a bit higher than where we are today. Compared to the 3-year average, where the 3-year average is 46% higher. So you get it. Demand is exceptionally muted, and the inventory is still down. So the combination of the two, we have low demand and low supply. So today we're at 8,156. It didn't go down much, only 0.6%. I attribute this last week to actually interest rates going down. And that's why we saw inventory go down a little bit more, as well as we're seeing demand not go down as much. The only thing that would explain this is that we've seen a bit of interest rates coming down from their highest heights, and some people taking advantage of that. And people are doing a lot of different things, paying points, and there's so many. You got to get with your lender because your lenders know so many different programs that they can plug everybody into. But SoCal, LA is at 2,808, their demand. It's off 32% compared to the 3-year average. Orange County is at 1148, off 36% compared to the 3-year average prior to COVID. Riverside, 1617, off 26% compared to the 3-year average. San Bernardino, 1164, off 38%. San Diego, 1419, off 36%. And Ventura is at 371, off 36%. So by and large, everybody's off quite a bit compared to the 3-year average. So it's muted demand across the board. And demand, typically, it peaks right over here. It peaked a little bit earlier because of interest rates going up. Demand is going to continue to go down for the rest of the year. It might not go down at the same rate that it typically does, but it will for once we get more into next week, the holiday week, the last couple of weeks, it's going to be it's definitely going to slow down demand as well as the inventory side of things. So the speed of the market, this is expected market time. Place your home on the market when you open up escrow. I'm showing you Orange County. The reason for that is because check it out. Orange County has these Himalayas on the left. Guess what? All my other slides don't have those Himalayas. They have everything on the right. So it's missing the volatility of a very, very low demand coupled with a glut of homes. The opposite of we have low demand today, but we have a very, very low supply. So when that happens, you could see over here, we had an expected market time of over 200 days and over 400 days. And that's missing for all of SoCal. I just don't have the specifics for each of the areas. Now, this, as you can see, we're looking, the black line shows you everything to the right of the black line in the prior slide. And this is where we are today. So where we are today is ever since we've been in an expansion of 2012 on. It's actually, we've been slower at the beginning of the COVID and also when we had 2018 at the end of the year when we reached 5% in interest rates. Actually, it was a slower time than what it feels like in the marketplace today. Jackson Hole, Wyoming, I'm pointing to it. So the expected market time was actually dropping and the market was getting hotter in the month of August because we had rates that came down, but then rates went up. And then what happened? We see the orange line that rates after Jackson Hole kept on climbing, and not rates, but the expected market time kept going up. March 17th, we're at a 24-day expected market time for all of Southern California. Many markets hit their all-time low in March. And December 8th, last week, we rose all the way to 101 days. It was up 1 day in a 2-week period of time. Last year, we were at 29 days. I had never really seen anything below 40. Below 40 is a new level that I call insane. Below 60 is what I consider hot. So we were at an insane market for like 2 years. But now we're at 101 for all of SoCal. There are markets that are below 90. A few of them, Orange County and San Diego, are a couple of them that are hanging out there. The 3-year average prior to COVID is 92 days. So we're not that off of that 3-year average. Today we're at 97 days. So it actually went from 101 to 97 because demand didn't go down, but inventory did. So the market's actually hotter than where it was last week. So SoCal, LA is at 100 days. It was at 81 days. That's the 3-year average prior to COVID. So I like to give you what it was prior to COVID because these last couple of years, you can't compare them to that. Instead, when things were normal. Orange County's at 77 days, was at 87 days prior to COVID. Riverside, 115 days prior to COVID. San Bernardino, 118, 95 days. San Diego's at 73 days, 80 days prior to COVID. And Ventura's at 69. It was at 70 days, the 3 years prior to COVID. So this is where we're going to go for the rest of the year is actually just going to be flat. This is where we're at. It's actually in what I refer to as balanced market territory, but it's not really doesn't feel like a balanced market if you are a buyer or seller. And I'll explain that in a second because we're just about there. Home values, we're not going to crash. That's not going to happen. And we're not going to have a wave of foreclosures. That's not going to happen. The overall delinquency rate across the nation is extremely low. It's at decades low. You could see where it spiked up during COVID because it included forbearances. Pretty much most everybody's out of forbearance. The people that are out either stayed in their home and worked it out because rates are so low, or they sold their house. It's 91%. Did that. The other 9% are working with workout unit, or there's 5% that are in the foreclosure process or have a notice of default. And the Great Recession, I wanted to point out this: over 40% of all mortgages had less than 10% equity. That was at the start of the Great Recession. You could see why everything imploded. And 28% of all mortgages were fully underwater. I just showed you a slide where the national delinquency rate is next to nothing at decades low. In Orange County, we're at 9 days and 54 days. And I'm going to show you this line because I'm going to show you a chart that just has 9 distressed homes in all of Orange County right now. You can't even see it. There's 54 prior to COVID. So we're going to make our way prior to COVID, which is when nobody was looking for foreclosures or short sales. We're just at a really minimal number. But you could see on the left, the Himalayas again missing when we had 6,000 homes. A third of everything that was on the market was either a foreclosure or a short sale back in 2007. And that's what I'm pointing to over there. Now, this is to the right of that black line from the previous. This is 2012 on. We're at 208 foreclosures and short sales for all of Southern California right now available for sale in all of SoCal. Prior to COVID, at this time of year, we had 538 in December of 2019. And it drilled its way down to that number in December of 2019. You could see it was higher in prior years during the expansion years from 2012 on. So, and I do want everybody to know that there's not going to be any panic sellings. Housing is not a commodity. Everybody needs a roof over their head. If they sold their house, they'd have to go rent, which rents are high, or they'd have to go purchase something else. So that's not going to happen. There's not really a bubble. The Fed kind of created a bubble by inflating artificially, making interest rates as high as they are so that they would bring supply and demand better alignment, is what they say for real estate. But prices are not going to plunge 35%. That is what it takes in order for it to be a bubble, for prices to go down 35% plus. So that's not going to happen. We are experiencing a housing correction, and that's where values go down between 10 and 20%, and that is what we're experiencing right now. So today's housing stock is extremely strong, and it's not the Great Recession years where we were putting people into homes that didn't really qualify for homes. They fogged a mirror. They didn't even have to fog a mirror back then. So that's not going to happen. Instead, the housing stock today is made out of brick. It's very solid. And its lowest leverage of all time is what we're dealing with right now. Record tappable equity, very, very strong credit. For years, people with strong credit have been purchasing very, very good jobs out there. Job market's really strong. They've been buying. I'm going to show you the difference between the Great Recession, the house made of hay versus the one made of brick. You can see on the left, it's a mixed bag of FICO scores. The one on the right, pretty much everybody has a really strong FICO score. And when we had all those multiple offers, the one that was strongest is the one that won. And it's typically the person with the biggest down payment and the best FICO scores and all that stuff. So that's who is winning for a very long time. That's what we built this housing market on, this housing stock. And the purchase applications on a weekly basis, this comes out on a weekly basis. Back in prior to the Great Recession, we were filling a credit bubble where we gave anybody a loan back then. I said you had to fog a mirror, but that's not necessarily true. Dogs, 2 dogs across the United States actually were able to get a loan by fudging paperwork, and also a bunch of dead people got loans. So you didn't necessarily even have to fog a mirror to get a loan. It was people with Social Security numbers that were no longer alive actually purchased homes. That's the kind of fraud that was going on and the kind of stuff that we were dealing with. That was a credit bubble. Now we have this line that was going slowly up, and it had everything to do with demographics. And it was a boring line, so not a lot of people talked about it. It's just a yawner because good economics is absolutely boring. And that's what we were dealing with for quite some time. The market that we're currently experiencing looks like it's balanced. It's not really, that's where we are. And even in San Diego and Orange County, it is actually a slight seller's market. It's not a slight seller's market though. It's a buyer's market is what it feels like out there. And the reason for that is because there aren't that many buyers in the marketplace right now. And the ones that do exist are shrewd, taking their time. They're not willing to stretch. They're not going to overpay. They're going to come at a home giving the best possible value that they think a home is worth. And so they're taking their time. They're being shrewd. They are throwing out all the frothy comps. They do not even want to see a frothy. If they see frothy comps, they see a property is based upon a frothy comp, it will get no activity. So there's this tug of war going on between buyers and sellers. Buyers are winning because of how high interest rates are. It will come better in alignment as interest rates fall. This what I just referred to is going to change because the model that we follow in economics is broken for supply and demand. And that is because of how high interest rates got. And I'm going to get myself into the weeds really quick. I love showing you this thing. And the reason for that is because that purple line in the middle says 6 months. When you have, and the blue line in the middle is no change in value. So to the right is where values are going up. To the left is where values are going down. So when you have an inventory level of less than 6 months up here, up here where the green portion is, if you have an inventory of less than 6 months, values have always gone up. And you could see that when you are below or when you have the market, the months of inventory is greater than 6 months, you could see that typically values go down. Not always, but values go down. That's the red portion. Now we're dealing with something called outliers. All of a sudden, this year alone, we have these triangles, and these triangles are July, August, September. And you can actually see 2 other triangles in the green section. That was May, then June, then July, August, and September is the one in the middle. What happened is interest rates got so high that it didn't even matter that inventory, because demand got so low that the few buyers that remained did not want to overpay, and they want a little bit of a deal. So as a result, we have values that are coming down. And even though we have a low inventory, we have values going down. Now, what do you think happens once interest rates start to fall? These triangles will move more towards the right as long as we have an inventory of less than 6 months, which is what we're projecting. We'll actually make our way at least to the blue line where values aren't going up or down. Could even get into the green line, we would have to see. So it'll be an interesting 2023. And the reason that there is this weird outliers that I just talked about is because of affordability and higher rates. Buyers today are extremely cautious. Property values, property prices are going down. And I want everybody to understand that the reason they're going down probably a little bit more than normal is because there are a lot more investors that are selling. And 28% of everybody that sold last year for the month of November was an investor. And I did this for October and November. It was at 28%. This year, it is at 32%. So there are more investors that are selling their houses. Not a whole lot more, but enough where these are the people that aren't as emotionally attached to their house, and they're more willing to do what it takes in order to get their investment sold. So, but there's still a stickiness to housing, and that's I showed you because the housing stock is very strong. They don't really have to sell. They like their home. If they can get the right price, they'll sell. That's kind of existing. There's this pricing strategy that exists today, and that is you need to spend hours coming up with the price if you're a seller. I hope that you spend 3 hours with your real estate professional coming up with the exact right price. It doesn't matter getting in and out and coming up with the price arbitrarily. It is the smartest thing you could do to price something right initially. And the way you price it right is if the property doesn't look like a model, that's what I'm showing, looks like a model, smells like a model, has a good location, has all the upgrades, amenities, newer, then you need to subtract from value. Inferior condition, inferior location, inferior upgrades, inferior amenities, age, all those factor into the value. And you have to put that all into the equation to come out with what the fair market value of a home is. You can no longer arbitrarily, like everybody got away with for 2 years. It now comes down to properly pricing out the door and throw away all the frothy comps. And it's glad that we're further in the year because now those are so far back that you can't really bring up frothy comps at this point. So market overview, and we'll get into our forecast. I want everybody to know that homes aren't selling above their list price. 26.3% in the month of October of all closed sales in California sold above their asking price. That's it. Now, prior to COVID, the highest ever was 40%. Earlier this year, in May, 72.8% of all closed sales sold above their asking price. That is unhealthy, unsustainable, and it's gone. Now we're at 26.3%. A number of homes that now the sales to list price ratio for all of Southern California in the month of October. By the way, this is updated tomorrow by CAR. Comes out tomorrow. It's at 97.3%. So people aren't getting their full asking price. That's because you're not supposed to get above asking price. That is not normal. For 2 years, people got above their asking price on average across all of California. Instead, now it's at 97.3%. And Case Shiller, one of the most accurate FHA home price index, is also another really good index to follow. The problem with those is they're so dated. But this recent one is through September. It's up 10.6% year over year. Earlier this year, we were up over 20% year over year. So it's coming down. And by the time we get to the end of the year, at least for Southern California, we're going to be at 0% up year over year. And it's going to continue to go down. For LA, for 3 months straight, if you combine those, it's off 6%, down 6% from the peak earlier this year. San Diego is down 7% from the peak to September, and we know that values continue to go down October and November. So as we get towards the end of the year, we'll be erasing most of what we've done in 2022. And as far as closed sales are concerned, in 2022, it's off 24% compared to the unicorn year that was last year. We did the most sales since 2005. But if you compare it to 2019, it's off 11% compared to 2019. And Southern California luxury is only, I said off 24%. That is a lie. It's supposed to say off 2%. I didn't fix this slide. So apologize for that. It's off 2% compared to last year. It was a record year. Last year was a total record year for luxury. Now, as far as the 2023 forecast is concerned, I don't know exactly where we're going to go. For Pete's sake, I'm only human. And I do have my concerns. And my 2023 concerns are, number one, uncertainty. Who in the world is certain as to what's going to happen out there? I didn't know COVID was going to come. And we all learned something big once we had that once in every 100-year virus like that. Battle of inflation. We're going to be dealing with inflation for the better part of this decade and the better part of this century. And the better part of this century because we have a demographics problem with baby boomers aging out of the workforce, and we don't have enough replacement workers for them. So that's a real issue that politics is going to have to help take care of that. It has a lot to do with like legal immigration, things like that. Rates remain high. That's a concern of mine. It's beginning to fade a lot. As you heard at the beginning of this forecast, Fed overshoots and causes deeper recession. I definitely think that can happen. That is, they would rather overshoot than undershoot and have to do this twice. They want us to take our medicine and get this done and get inflation back into a better area. Job openings remain too hot. It's still too high. I want to see this come down. The Fed wants to see this come down. You shouldn't have 2 jobs for every job seeker. That's not healthy long term, so that they're trying to fix that as well. Hunker down trend deepens. It already has deepened. The only way that this is going to loosen up a little bit is as interest rates come down. Where do I think that threshold is once we get below 5.5%, people aren't going to hunker down as much. There's still a lot of people that want to move. They can't move because their interest rates are so good. But once they get below 5.5%, they go, let's just go ahead and do it. Global turmoil, always concerned about that. There's other things brewing in the world. Supply chain issues, there's still issues with supplies. I've had issues getting some things for my office. Distress rises slightly, no wave. That is what's going to happen for next year. We could have more, even if it doubles. It's where we were prior to COVID. Normal housing season, spring is the best, then it's summer, then it's autumn, then winter, last is holidays, which we're in right now. Muted demand continues due to persistent high rate, but rises as rates drop. So know that we're going to get these drops in interest rates next year. Exactly when that happens is kind of like guesswork. I mean, we have our ideas, but when that does happen, we're going to see these increases in demand. We saw it in August of this year. We're starting to see it a little bit right now. These little upticks. This is going to feed to a better 2023 once we start to see rates come down a bit. It doesn't mean we're returning to the heydays of 2020 and 2021. It means that the supply and demand thing will then be able to reflect what's really going on in the housing market. Those outliers we talked about earlier. Low inventory to start the year, under 25,000. Normally, we start off the year at about 35,000 if you look at the averages going back for about a decade. Rise in inventory eclipsing 35,000 homes. That's where we peak. And normally we peak around 44,000 homes if you look at my averages going back in time. So we're making our way back towards average. We're just not going to quite get there yet. We're still dealing with a muted inventory. And then homeowners continue to hunker down until rates drop enough for them to get in. I told you they need to be about 5.5% to really start to see this change. Luxury sluggish transition to a normal longer market time. I want everybody to know that 60-day expected market time for luxury is not normal. That's not normal. I have not seen it before. I've been doing this for 30 some odd years, and it's just not normal. It's supposed to take months. You're supposed to take a 6-month listing contract when you take a property at $2-3 million. It shouldn't sell instantly within 2 months. And that is where we're transitioning back to a normal luxury market. And closed sales down 6.5% to 8%. Compared to this year, so a little bit less, and that has a lot to do with the beginning of this. The beginning of this year was a bit hotter. We sold quite a few homes at the beginning of the year. Home values drop in 2023, down 6.5% to 8.5% year over year. And I mean, I was working with these numbers as much as possible. This is with rounding 6.5% to 8.5% is kind of where I'm thinking values will come down. 6.5 down, only 6.5%. It just depends upon when interest rates get to where we think they need to be. If it takes longer, 8.5%. If it happens sooner, then 6.5%. That's kind of how we're leaning on this. Interest rates from 4.75% to 6.5%. 6.5% is my lid. I talked about that. We're already making our way towards 5%. I could see getting down, getting under 6%. I can see getting down under 6%, and then being about. Like I said, strong potential for rates to come down to low 5%. I've talked about this before, but we could get here by the summer of 2023. There is a chance of this happening, and when that happens, demand rises. It may happen later on, like August or September. However, it's something that we're dialing in to see. We think interest rates are going to get down into the fives, could even surprise people and break below 5%. There are pathways for that to occur. So if you want free content, go to reportsonhouse.com. I do have a free content page there. You can go there to subscribe. Reports on Housing. We email these out, and there's a bunch of links for you to repurpose these things. It comes out every 2 weeks. $15 per month or $150 per year. You get 2 months free, not 1 month free like I normally do. 2 months free if you sign up utilizing the coupon code 2023. And that's all I have for everybody. Go to Reports on Housing to subscribe. I appreciate it. What happened? What happened to me? There we are. So Go to Reports Announcing and subscribe. Thank you so much for bearing with me. This was a little bit longer than I anticipated, but you know what? I wanted to bring you the latest and greatest. I spent a lot of time coming up with this forecast because I wanted it to be dialed in so we can properly set everybody's expectations, and hope everybody has wonderful holiday season. We can't wait for our Christmas Eve party. It's going to be absolutely fantastic here at the Thomases with our family. It's our turn to host. And I hope everybody has a fantastic new year ringing in 2023. We will see you on the other side of the new year. Thank you so much and have a fantastic